Hi, I'm Richard Vague with Tychos. On Friday, a Financial Times headline seemed to lament, quote, "EuroZone bond yields sink to 9-month low as economy struggles," end quote. After all, since bond prices rise when yields sink, the headline could have just as easily been written as a celebration of those lower rates. It could have read, quote, "EuroZone bond prices surge to 9-month high as economy struggles," end quote. So which do we prefer? High interest rates or low interest rates? And more importantly, which way are they headed now? First, let's look at what they did for the roughly 40 years prior to the 2020 pandemic. In 1981, the 10-year Treasury bond had a yield of 14%. By 29, that had declined all the way to 2%. That happened in spite of the fact that government debt rose precipitously during that stretch, from 32% to 109% of GDP, and the money supply had grown from 55% to 72% of GDP. Note that private debt grew rapidly as well, from 99% to 159% of GDP. Wait, you might ask. Don't the textbooks tell us that interest rates are supposed to go up when government debt or the money supply go up? And given that private debt was growing rapidly too, wasn't that the crowding out the textbooks warn us of, with the government and private sector borrowers competing for scarce dollars in a way that forced interest rates up even more? No, interest rates went down sharply, so it turns out the textbooks aren't close to being correct on this one. In actual practice, it is much more typical for interest rates to go down when debt goes up, in an inverse relation that we might even view as causal. In fact, it was the Fed's increases in interest rates from 0.8% to 5.3% over a 14-month span that might be considered the aberration. The Fed still holds to the theory that growth in government debt and the money supply bring inflation, even though most of the time that has not been the case, as with the huge growth in government debt and the money supply in the U.S. after the global financial crisis and Japan after its 1990s crisis. Instead, COVID supply chain issues and the impact of war on oil prices brought that inflation. And we can clearly see now that high rates were not needed to bring inflation down, since for the past 16 months, starting in July of 2022, inflation came down abruptly, averaging an annualized monthly inflation of 3% at a time when interest rates were only 2%. Many analysts now believe that the Fed is telegraphing 3 interest rate cuts for the upcoming year, which, if true, will be good news and appropriate news, and will get interest rates down closer to where they should have been all along. But we aren't out of the woods. We've got enough war across the globe that energy prices could again jump higher, and if they do, all bets would be off, at least for a time. The Fed, of course, can do as it pleases on interest rates, but it is reasonable to think that they will come down over the next year, which will be welcome news for our economy. That's it for this week. Thanks.